Throughout the course, we've spoken often of the logic of the corporate form for organizing economic activity. We've seen through our textbook and class materials and subsequent materials why the corporation became the dominant way of organizing economic activity. Of course, a whole range of not-for-profit activities as well too, which we will discuss in other contexts. So we see the rationales for the company, but of course one of the most striking things if we watch the news day to day is, in a sense, the fight for control of the company. Who has control of the company? We've seen this when we talk about the politics of corporate governance and in whose interest the company should act. For society at large, a kind of a stakeholder view of capitalism, or a more shareholder-centered view of capitalism, which has been a dominant way of thinking about the enterprise, at least in the Anglo-American world, for a number of decades. And of course, there are various social democratic and political perspectives which argue that the firm should give particular priority to its immediate stakeholders, employees, for example, or certain categories of employees. If we're to watch the news, we will see that a lot of the attention it's given to the companies is actually about fights for ownership of the firm and, by implication, control, particularly when we see takeover bids, for example, by one company for another. Now, very often a takeover bid will have the support of the target company's management, and this raises some of those issues of in whose interest the firm is governed. Shareholders might very much welcome a takeover bid. They get to sell the shares in the company, perhaps because they have much better information about the prospects, good or bad, for the company than other stakeholders. They may be in a better position to decide whether a takeover bid that's offered for a company represents fair value or not. And we see that there's a very significant community of professionals, accountants and other analysts who advise the boards of takeover companies, as well as advising investors and other companies who would like to acquire a company through a takeover, what fair market value might be. But of course, employees who fear a takeover by another company may be worried that job cuts or just different ways of doing business may result. So employees' interests and managers' interests and shareholders' interests might diverge. We can speak in general terms about corporate control events. When we see control of the corporation, and typically we're talking here about a for-profit company, changing hands in some way or another. It is possible for not-for-profits as well too. Indeed, in a Japanese context, we've seen some university mergers and yet more discussions. Indeed, recently in the media, there's even been conversations about whether Waseda might buy a medical school effectively through merging with an existing institution. I think that probably takes the Soke competition a little bit too far. Just because your competition has something doesn't mean necessarily that you should have it, especially if you don't know anything about running something so distinctive as a medical school. But anyway, maybe wiser heads in Waseda will make an apt strategic decision on that. So I want to speak briefly to this set of slides that you've got there on Moodle entitled Corporate Control Events. And as the second slide here says, that there are a number of different types of control events. There's the open market purchase that happens through the share market, of course. There's a tender offer process where the potential acquirer explicitly makes a tender for shares in the company. And in most cases, it's required to be at the same price for all shares to all shareholders, regardless of whether they're a larger shareholder or a smaller shareholder. This is where basic rules in relation to financial markets and the listing of companies have a very big impact. Imagine a company that's publicly listed that has one block shareholder that has 60% of the shares, plus the remaining shareholders are a wide array of smaller investors, maybe individuals who only have a very few shares in the company that make up, say, 40%. Now, the acquiring company may be looking for strategic alignment with the company taking it over, the target company taking it over. And so they really only need to get control. And say 60% of the shares may allow them to absolutely dominate appointments to the board and then once they control the board, to control the executives, the senior management appointments, and therefore impact the strategic direction of the company. So there's a great danger that an acquirer may only want to buy just enough shares to get control, or may want all the shares but would differentially price them. So they might go and offer what we call a premium for control to the larger shareholders to secure control, and then do through its second tier offering to offer a lower price to all of those fragmentary minority shareholders. So in order to protect the interests of all shareholders, investors in the firm, typically we have rules which require the offer to be made on a non-exclusive basis to all shareholders at the same price. You can imagine that very big institutional investors, that large players in financial markets but may only have 1 to 2% shares in any particular company, will be very strong advocates for this. So it doesn't mean that governments have always just favored the smallest of the shareholders. It can be that they're favoring very large players in financial markets, but have only small stakes in any particular company. Now, we see some other mechanisms as well for bringing about change of ownership of a company. And a very important point here that I think is sometimes forgotten is that the shares of one company are a currency that can be used in the market for corporate control. And we see this through the share swap, the third thing I've got here on the slides here. This is where there's typically negotiation between the senior executives of both companies, of course, in tandem with the boards of both companies, because it has to get approved by the board, where effectively one company would acquire another, and the currency they would use to pay for the shares in the other company would be their own shares. So the negotiation is not about a cash price, but it's about a effectively conversion rate for the target company shares into the acquirer's shares. Now, we sometimes see a hybrid model. We sometimes see a cash and share mix as well. And there are various reasons for this. Sometimes for investors, it's much more tax effective to just simply switch one set of shares in one company for shares in another company. It depends a lot on how the rules work. For example, if a share price has gone up or down over time and you were to sell those shares, a cash transaction, that would be a significant deeming event from a tax point of view, and a tax liability or a tax credit may arise. On the other hand, tax rules may simply treat a change in share status, that is switching one shares for another, as not a control event, and therefore a tax bill may not accrue. For example, if the target company's share price had risen over time, and the owners of the shares, if they'd actually accepted cash for it, might have to pay what we call capital gains tax, a tax on the shares increase in value since they owned them. And typically when we see something like share swap, by definition it's a friendly takeover. Effectively what is happening here is that the target company's board is collaborating as well with the acquirer. It is certainly possible to make a hostile takeover bid offering shares. That gets rather more complicated though, and so it's extremely unlikely. The far more likely thing is that a hostile takeover bid will actually offer cash. And of course, then the target company has to make a recommendation to the management, has to make a recommendation to their shareholders about whether they think the offer for the shares in the company represents fair value or not. It's very clear that legally, and of course morally, the managers, the top executives of a company, the board of directors, in turn, have a responsibility to shareholders to act in good faith, to step out of their own immediate interests and to say, well, we can't imagine the share price rising any higher than this for a while. It seems to offer fair value, more than fair value. Therefore, we recommend that shareholders accept the takeover bid. And in that context, senior executives may actually face the prospect of losing their job. They may expect that the acquiring company will bring their own executive team in, that they will lose their jobs, but that they have moral responsibility to act in the interests of shareholders. That's very clear cut in at least Anglo-American law and in the culture of management in the context of control events. Now we see a subset of control events that became rather more common from the 1980s and which was discussed in our textbook. And these are things like leverage buyouts. This is where an investor uses leverage, that is, borrows a lot of money, enabled to buy shares in a company, obviously to gain control, to completely buy out the existing shareholders. And then, because of the accounting rules in some countries and tax rules and various sets of rules, if the shareholders exceed a certain percentage, typically say 90%, you often get to a stage of compulsory acquisition where the remaining shareholders have to sell, partly to overcome the inefficiencies of companies that are listed on the stock exchange with an overwhelmingly dominant shareholder and very thin trading in the shares. And we see in conjunction with that, what often happens is the laws then permit the debt of the acquirer to actually be put onto the books of the target company. So we do tend to find under some conditions, and even if that doesn't happen, but that the acquirer has large interest bill to pay for the money they borrowed to buy the company, they're going to run the company in a quite hard-headed kind of way to service the debt which was associated with taking control of the company in the first place. This is a major reason why internal stakeholders, particularly employees, trade unions, have long feared takeover bids that involve a lot of leverage, a lot of debt, because they fear, in the famous words of Michael Jensen, who we've heard from earlier, that debt is discipline. Now, there's a subset of leverage buyouts when the existing management of the company buy the company that they're managing off the shareholders of the company. So why would this happen? Maybe the shareholders are actually just not very interested in actively running the company. In some European continental economies, we see this, and we've talked about this in another context, where unless you actually have a block shareholder actively involved in supervising the company, you're in danger of being shaken down by other internal stakeholders, particularly when the law strongly defends, for example, organized employees in trade unions and whatnot. So unless there are family stakeholders interested in continuing the business, it may make more sense to actually sell the company literally to the managers who you've had a long-standing relationship with, who know the company well and want to continue to be involved in it. But they've got to get the money from somewhere typically. So they may raise loans and then buy out the company shareholders and become the owners of the business themselves. Now, in different contexts, less in the continental European case and more in the Anglo-American cases, a lot of questions arise if this happens, because we simply have to ask ourselves, well, if management are really doing their job properly, maximizing the value of the company now for the owners of the business, how is it that it's in their interest to actually go and borrow money, have the debt servicing burden, and then take control of the company themselves? Maybe they haven't been as tough a set of managers when they were running the business for someone else as they would be if they were running it for themselves, and that raises interesting issues. So if there are practical reasons why the shareholders want to sell out, often the management buyout is a very desirable, a very respectable thing. The existing management wants to maintain the enterprise, grow the enterprise that they have been heavily involved with themselves for a long time as managers. Now, we can think in terms of control events too in another context. And this is where companies find themselves short of capital. They need to raise money. They could go to banks and get debt financing, of course, but that brings a fixed servicing cost. Another thing they can do is to go to the existing shareholders and ask them to put more money in. Now, if this comes about because a company sees great new business opportunities that needs extra cash, then shareholders very often welcome this. And typically the capital raising comes at a little bit of a discount, so the shareholders actually can do very well taking up these offers. Very often, though, it looks more like a shakedown, that actually a company finds themselves in a difficult position, and this often happens in financial crises, that they need more working capital fast. the prospects for the company, if they don't get it, are rather poor. So the shareholders find themselves in a really invidious position. If they don't pony up, if they don't come up with more cash to buy new shares that are being issued, this is the typical way you raise money from from the equity market. You issue new shares, then effectively they will suffer what we call dilution. The value of the existing shares are going to be reduced by the total value of the new shares being issued. Simply, there are more shares, more owners in an existing business with an existing stream of revenues. Okay, so the profits just have to be spread more thinly across existing shareholders. So it's very often an awkward position that shareholders find themselves in. Sometimes it gets even more complicated when the shareholders, for whatever reason, are actually prohibited from taking up more shares. I personally have experienced this living in Japan, having some shares that I had bought years ago when I could freely buy shares in Australia. But very often the offerings by companies with a capital raising, because of the compliance reasons, the legal requirements in my country, in Australia, before a company sells shares to anyone, that you have to issue them a prospectus, a detailed analysis of the economics of the company. Now, a prospectus applies in the rules of the country where the offer is being made. So what often happens is that non-resident shareholders are disenfranchised. They are actually prohibited from taking up shares in a share offer with a recapitalization. Now, companies can deal with this one of two ways. They can say, bad luck, and therefore the shareholders are suffering the costs of dilution without any compensation. The more ethical way to do it, and sometimes required by law in some countries, is that all of the shares that would have been issued to ineligible shareholders are put into a pool, they're sold in the market, and then the revenues are then divided up and paid to the shareholders as compensation. And I've got some checks in the past, small checks, because only small shareholdings, because of those kind of mechanisms. They're always controversial, extra capital raisings, because effectively they go to shareholders, existing shareholders, and say, especially in difficult times, either don't take up your offer here and have your stakeholdings diluted, or if you do take up the offering, of course you've got to find some money real fast to pay us. Now, another control event, the final one I've got in the slides here, is the spin-off. And a spin-off is typically where you've got an existing listed company that doesn't have to be listed, but it's typically a listed company, publicly traded, that it has a range of different businesses within the boundaries of the firm. And it decides that greater efficiencies or market value would be realized by separating out those businesses into distinctive companies. And part of that process, of course, is assigning value to each, and typically something akin to what we saw earlier with the share swap. But we see existing shareholders end up with two sets of shares. They have the shares in the existing business, and in the new spun-off business gets a whole bunch of new shareholders, who are mostly the old shareholders, who end up holding two sets of shares. Now, there are two reasons for this, for these kind of spin-offs. One is that obviously large companies can become unwieldy, the kind of things that our textbook authors talked about, that the multi-divisional firm can become very bureaucratic, can be strategically difficult to manage. So having smaller enterprises focused on core competencies can be a major competitive advantage for firms. And of course, the share market often values that. They like more focused companies, and as a consequence will value them highly. But there's also that other portfolio risk issue that we touched on when we talked about in finance earlier in the semester. And this is that investors that are diversifying themselves, putting together a portfolio of assets, are not so comfortable with companies which do too many things. Now, within a company, they are effectively hedging against the risk of a particular business sector or a product doing more poorly by being in a range of businesses. Shareholders are less at ease about that, for the very simple reason that many, particularly professional investors, want to make their own diversification decisions. They don't want to have a business that's in 20, 30, 40, 50 different businesses. They would rather make that diversification mix themselves, the investors do, based on their own vision strategically of where they think the economy is going and what suits their own interests given the other investments that may have. For example, if you're already invested in property because you own an investment property or something like that, an apartment, then you may not want a business that you have shares in to diversify into the property sector because you've already got what we say is exposure there. So sometimes what we find is the various businesses in a large enterprise collectively are worth more if they're separated. The parts are worth more than the sum because investors, professional investors, are less interested in a multi-product, multi-risk, multi-exposure business than they are in boutique businesses that have a clear value proposition. So when we have control events, there are costs and there are advantages. Very often by bringing diverse businesses together, we bring about efficiencies, and much of the discussion in our textbook, particularly with the great barons of industry that emerged in the United States in the second half of the 19th century, we see the likes of the Vanderbilts, J.P. Morgan, others, really built their enormous fortunes by buying up lots of firms and assembling together and gathering economies of scale, not just in manufacturing, for example, but in coordinating their enterprises, in managerial efficiencies and whatnot. So we see that there are very significant advantages that accrue, but there are disadvantages as well too. First of all, the benefits. The benefits to shareholders, of course, you get to sell your shares very often at a premium and a premium for control. So by selling out, you can do very well. Now, when debt has to be serviced, though, as I've talked about, this can impose costs on an enterprise, and that's why you get stakeholders such as unions who are wary. As I say in the notes here, it does bring a debt discipline, and to be honest, who likes discipline? Discipline is good to inflict on others to protect your own interests, maximize your returns, but who signs up for discipline for yourself? Okay. In terms of hostile takeover bids, insofar as management are entrenched and unadventurous and not really driving the company to act in the interests of shareholders, maybe at the expense of internal stakeholders, such as employees, then takeovers can bring about a significant positive disciplinary change. In terms of the business might be revitalized, but that will always be at the expense of some people. There is a significant zero-sum game here as well. If mismanaged firms continue to be so for a long time, you expect the share price would fall. Naturally, investors don't want to invest in companies that are not doing very well. Okay, this does naturally allow entrepreneurs, investors, for example, to consider a takeover bid. So underperformance in markets where there is a dynamic market for corporate control very much helps to naturally attenuate this. Effectively, the assets become cheaper, a takeover bid becomes more affordable, and the potential returns to that takeover bid become larger. So a very vibrant market for corporate control, just because it's a possibility, even if it doesn't actually happen in relation to most companies, potentially creates a discipline upon management to manage the companies well. Okay. Now, if you do get a takeover bid, you take control of the company, you fix it, it becomes a more valuable enterprise, then of course the share price should rise naturally. And then of course there is the option to sell out those shares, to cash out. Sometimes in very casual terms, flipping. If people come in very quickly, fix an asset and sell it again. This notion of flipping also applies to real estate. A house in a bad state, you come in, you clean it up, quick, lick of paint, fix the worst aspects, put it back on the market again for a quick capital gain. Now, the investors who do that with companies very often create considerable fear amongst employees in a target company. particularly if they think that to make a company look much better, to, in a sense, improve the share price and to exit very quickly, that a lot of things that value in the company, but in the short term cost money, such as research and development, keeping long-term experienced valuable employees, or the reverse, getting rid of them because they're relatively more costly than newer hires or outsourced labor, for example. By, in the short term, just simply cutting costs. Longer term, you might be weakening your company, but in the short term, you might be making it looking better to sell. Okay, so there's a lot of concerns about that. So when we see internal stakeholders, management, and often with the backing of employees, resisting a takeover bids, we can see fights that really go right to the shareholders, and often a general meeting of the shareholders. And it can be what we call a proxy fight. These are the votes that represent shareholders, the voting shares, and you can get very intense fights to see whether a takeover bid will succeed or not. Target companies have certain mechanisms for defending themselves from takeover bids. Well, we should say at least the managements do, because those kind of defenses are very rarely in the interests of shareholders, because in the end a shareholder can sell the shares, right? So if they're getting a decent offer. So to make sure that all shareholders get well treated, we've talked about, there are things like fair price provisions, compulsory offer and acquisition rules, as I mentioned in the slides, I've touched on, when you go above a certain threshold. The really controversial one is what we call a poison pill defense. Now, a poison pill defense makes it very costly for an acquiring company to take control of the shares. Now, there are several ways to do this, but the typical poison pill defense effectively issues shares to all the other shareholders except for the potential acquirer, so whoever's trying to take over the business. And effectively what they're doing is they're designing targeted dilution. So for example, the target company may issue 4 shares for every existing share, but they don't give them to the company or the investor who is a shareholder, because they've bought some shares already, who is looking to take them over. So that is to make them the acquisition very costly. And there are some other mechanisms as well too, where effectively management can assign themselves with a compliant board a golden parachute, where in the end, in the event of a corporate control event where their services are no longer required, where they no longer continue as managers, that effectively the company has to pay them a very large amount of compensation to leave, making it more costly to acquire the company in the first place. Okay. There are several responses that management can also engage in. They can go and find a more friendly acquirer, maybe an existing firm that they have positive relationship with, who they think will be a less tough owner than the company that's making the hostile, the uninvited, and opposed bid for the target company. Greenmail is effectively a situation where you get investors who aggressively look to take over a company, and the target management doesn't want the takeover bid. So they effectively buy the shares off the investor that they've already bought, and at a premium, on the understanding that they'll go away. Okay, so we often call this Greenmail. So effectively, shareholders that are loyal shareholders end up suffering to some degree, because resources of the firm are actually used to pay other shareholders who are threatening to launch a takeover bid to go away. And one of the funny quirks of what's happened in Japan is that law has evolved to actually potentially make that possible, because of a very famous case, the Bulldog Sauce case, which hasn't really been used so much in Japanese case, but I wouldn't be surprised if we do see more kind of Greenmail instances subsequently. I want to speak very briefly to private equity in the context of this, and particularly to speak then to the Bulldog Sauce case. Now, the textbook has spoken about private equity a little bit, and particularly leverage buyouts. But some of the largest players now in markets for corporate controls are very large institutional investors. For example, Bain Capital is the new, I guess, proud owner of Virgin Airlines in Australia. I somewhere have on my computer here a little letter telling me that my shares in Virgin are worth absolutely nothing, that the company had more debts than they could pay with the COVID-19 shutdown. And they were put into administration, so bankruptcy protection, and then Bain Capital, which specializes in buying up effectively somewhat distressed businesses and turning them around and making them profitable, and then selling out shares or keeping shares in them if they're doing very well for a very healthy profit. Okay, so they got my shares in Virgin, but at least in theory the company was worth nothing at the time. So private equity is something that lots of students say they would like to go and work in because they hear of great bonuses for doing deals and all the rest of it. It does help if you're very good at maths for a start, but also if you're not bad at law and related fields, professional fields, then they can offer interesting but very challenging career opportunities. So what we see with private equity is several drivers of this. Deregulation of financial markets made money easier to get. Institutional investors were also looking for higher returns beyond what the regular share market can get. So we get a huge array of institutional investors that effectively have a private equity kind of function to them. Even not-for-profit funds, such as the superannuation fund, the retirement fund I was in Australia, they took a strategic stake in an airport, which doesn't look like such a good business right now, but was quite profitable for them. So private equity often gets involved in businesses that have maybe not so dynamic management, but potentially stable enterprises offering a significant stream of rents. So we do see significant private equity investment interest in various infrastructure. For example, when governments privatize infrastructure, private equity often steps up and gets involved. And there are various other reasons for the growth of private equity. Tax effectiveness of debt, for example, in the US and a number of other countries is one factor there. The GFC, global financial crisis, back in 2007, 2008, impacted negatively. We've seen a return to significant levels of private equity investment activity, and I anticipate that after the COVID shock, we will see more private equity deals. And we'll see it for two reasons. There are lots of distressed businesses that potentially are up for a workout. And we are awash in cash. I think one of the really striking things that comes through from our reading in the course from Adair Turner is that many of our leading firms today are not very capital intensive. At the same time, we have aging population saving for retirement. So we have a lot of capital and diminished investment opportunities. So one can find capital fairly easily, of course, if one's a professional investor, in order to engage in the kind of deals that private equity like to do. So we're going to be seeing more and more of this. Now, finally, in the discussion in the slides, I talked about management's duty, the interest to maximize the obligation, the moral obligation to maximize the interests of shareholders, because management are ultimately working on behalf of the owners of the business, which even in Japanese law is quite clearly shareholders. And yet we see plenty of instances where management is strongly resistant to takeover bids. And let me give you some examples. One example, reaching over here, I raided my kitchen just before. Okay, what do we got? That is Bulldog Sauce. Okay, Bulldog was quite a striking case. There was an American investment fund who took up shares in Bulldog and were looking to take control with a vision of significantly rationalizing the company. Thought it had a lot of growth prospects, but it had a lot of efficiencies as well. Okay, and it was very strongly resisted. It became a major source of news in Japan, and it did in part because Bulldog Sauce issued a poison pill defense which diluted significantly the shareholding of the American investment fund that was looking to take control of it. And then that was contested in the courts here in Japan, and it went up through 3 different trials. And the final outcome was, I think, Japanese word chutahampa kind of perfectly captures it, that actually the poison pill defenses were upheld by the court, but with a very significant qualification. And the qualification was that the losses accruing to the investment fund through the dilution had to be compensated by cash. So Bulldog Sauce had to buy the shares off the American investment fund and compensate them for the dilution. So actually the American investment fund got away with making a reasonable profit, probably not as much as if they got control of the company and done what they wanted to do, rationalizing it. But effectively looked like a low-level version of Greenmail. And I anticipate, at least the possibility, that the precedents that were created in law with the Bulldog Sauce case could give rise to further more kind of cynical Greenmail efforts, where investors come along, they take a stake in a company, they threaten to go for a full takeover bid, TOB, and effectively get bought off by the existing management. Now, why am I holding 2 bottles of sauce and not 1? Okay, because this is not Bulldog Sauce. Okay, this is Lee and Perrin's Worcestershire sauce. Okay, because I want to make the point that takeover bids, when they cross national boundaries, often trigger strong nationalistic sentiments. And a lot of the discussion at the time about the Bulldog Sauce case was very much in terms of these terrible American investors who come in, they know the price of everything, the value of nothing, they want to aggressively take over a business, make tough decisions and get away with a high profit. And everyone else involved with the business will be the loser, will be the poorer for it. That narrative was quite strong. We see very prominent newspapers, including the Yomiuri, being very critical, saying that, of course, Bulldog Sauce had over a century of history and it was a beloved brand with a very distinctive product, and how outrageous it was that these foreign investors would come along in such a cynical fashion. Well, I wrote my PhD thesis about the politics of foreign investment in the Australian case, and set it in some international contexts. And I could go on about it all day. You can find my PhD thesis online. It's only about 350 pages. Don't go there unless you really, really want to. But I've got this other bottle of sauce just to make a really interesting point. Bulldog. You know, Bulldog, the name was adopted, Bulldog, because Bulldog was a symbol of Britain. Sauce in katakana comes from Worcestershire sauce. Worcestershire sauce is not in Worcestershire is not in Ibaraki, it is in England. And this one I've got here, the original and genuine Lee and Perrin's Worcestershire sauce by appointment of Her Majesty, blah, blah, blah. So, you know, this is a very English tradition. And in the Meiji Taisho period, when Yoshoku started to take hold, there was lots of borrowing of distinctive English things. Indeed, we got curry in Japan because the Japanese, the nascent Japanese Navy copied the British Navy's tradition of curry, which of course they got from the British Empire, being in India in the first place. So it was with truly, as we say in English, without a hint of irony, that we got this nationalist backlash against a takeover of a Japanese company selling Worcestershire sauce under the very English name of Bulldog, and it became a kind of a national imperative to defend this very distinctive Japanese company. But I'm not going to say this is a uniquely Japanese defensive thing, because we had very similar things in Australia. Arnott's Biscuits, makers of the Tim Tams and various other things. The chocolate mince slice, they're my favourites. I like them. Tim Tams are a bit sweet for me. But chocolate mince slice, they were taken over by the Campbell Soup Company of America. and lots of people decried that. They said that a national icon was being taken over. Actually, just down the road from the Arnott's where the Arnott's Biscuit factory used to be in Brisbane, was the 4X brewery, and I won't even begin to speak to what that brand 4X means to Americans, because it's a very different kind of product. But that was a very iconic beer, particularly in the state of Queensland, where I'm from. Then a New Zealand brewing company, Lion Nathan, came and had the audacity to take control of it, and of course the newspapers screamed that we were going to lose this iconic product. Then subsequently a Japanese brewer took it over, because they took over Lion Nathan, and by then people had pretty much forgotten about it. And of course lots of people are still drinking 4X beer and whatnot. So nationalism is a fairly natural impulse. Fear of outsiders is a quite natural impulse. And in the market for corporate control, target companies and their management and their employees, who may actually be fearing rationalization, naturally are going to reach for anything that helps them to win an argument, to say that a takeover bid shouldn't go ahead. And we will see this, I think, endlessly everywhere. Some countries, economic nationalism tends to resonate more than others. Generally, in the Anglo-American world, there is this very strong overriding belief in the efficiency gains from a liberal market for corporate control. And in a country like mine, although we've had recurrent bouts of nationalism in relation to investment, something like 2/3 of the entire manufacturing sector is actually foreign owned or controlled. And in minerals and energy, which is another major source of exports, it's something like a half, even more. So we see that there's lots of political contention, but in some contexts, ultimately the market for corporate control tends to play out, tends to dominate. I'll just simply conclude by making the observation with COVID that the nationalistic or the localist defense against the outsider, and it goes beyond nationalism, it's at the village, the state, the region level and whatnot as well. We see this very, very strongly, that when people are fearful, they are defensive, and sometimes politicians take advantage of this, and we've seen some fairly ugly populist responses. Even countries that really pride themselves on their openness, their liberalism, have retreated into very intense defensiveness in relation to population movements, for example. My own country has actually been one of the most severe on this, even down at the state level, with the closing of state borders and quarantine regimes between states. People moving across borders and whatnot. Unthinkable a year ago, I think, if you asked any Australian. So that instinct towards the fear of the outsider is a natural human instinct. I guess leadership is really about a dispassionate assessment of the pros and cons of any control of event, in the case of foreign investment or just simply purchased by another local company. And one of the other striking things we can say from a decade ago, when the Bulldog Sauce was very significant, a bit over a decade ago, about 15 years ago, around that time in Japan, a lot of resistance to takeover bids, mergers and whatnots was actually much less about the fear of foreigners than merely the fear of outsiders. We saw other very famous cases with Live Door and Fuji, with Rakuten and TBS, for example, with companies in the same market segment, Pentax and Hoya, where stakeholders in companies feared even other Japanese managers in another company would not act in the interests of their own employees. And so I think it goes beyond immediate financial interests to some broader identity issues as well too, particularly in the Japanese context, where people join a company as shinsotsu, as new employees, and they work all their lives there, and the company they joined is not the same as at the end as the one they started with. It's even completely changed their identity. Sometimes, though, this actually keeps your career alive. When I first came to Japan and taught English, I was teaching a bunch of very talented, very interesting people in Minolta Camera Company. Later on, Minolta merged with Konica Minolta, and then subsequently Konica Minolta was acquired by Sony. Now, Sony is still a major player, of course, in digital imaging, is one of, very significantly became a very strong third player to Canon and Nikon in digital cameras, leveraging some of its expertise originally in video cameras, but also the huge amount of expertise that it gained through Konica Minolta, which were two separate companies as well too. And so people who were very young when I first met them as an English teacher going out to a Minolta factory in Toyokawa, riding a train out to there from Nagoya, would now be quite senior managers and engineers in Sony. And we have to seriously consider that neither Konica nor Minolta might have survived, probably would not have survived in the camera business if they had stayed alive. So yes, people had to change their entire corporate identity twice, but maybe their careers in the industry they chose to be in the camera business, continued. They survived in that business because of the corporate control events. So we don't only want to see in negative terms, we want to see in positive terms. And as for the COVID case, well, that's a complex set of very different issues, but the instincts to defensiveness are similar to the resistance to control events.